For the precious metals panel, I'd like to invite up to the stage Scott Hicks, VP Corporate Development and Communications at Lumina Gold, Marshall Koval, Chief Executive Officer at Lumina Gold, and Nikos Kavalis, Managing Director for Singapore at Metals Focus. Maybe we can start off with just a very quick introduction from each of our panelists. Just share a little bit about yourselves and your background in the space.
Hi, I'm Scott Hicks. I work with Marshall at Lumina Gold. I came out of the investment banking industry, so I was at BMO Capital Markets and RBC Capital Markets for a decade there, and I've been working with the Lumina Group since about 2017 on the corporate side.
I'm Nikos Kavalis. I'm one of the founders of Metals Focus, the precious metals research consultancy. My background has always been analytical. I've always been an analyst. Before Metals Focus, I was working for a bank for a bit, and before that, for what basically used to be Metals Focus' biggest competitor.
Yeah, Marshall Koval, been in the mining industry about 45 years now. Started out right out of college when I was 21. Worked for major mining companies, ran a consultancy, Pincock, Allen and Holt. We did independent engineering for banks on project finance. Spent a lot of my career in the gold and copper sector. I've been part of the Lumina Group that Ross Beatty found since, I guess, 2004. And also serve on the board of Equinox Gold. It's a producer, mid-tier producer with 8 mines in the Americas, and CEO of Lumina Gold.
So, because we have mostly gold experts in this on this session, I thought we could kick off with a very easy question: will gold continue breaking record highs?
Yeah, I think so. Look, after the kind of speculative inflows that we've probably seen in the last 5 to 10 days, 5 to 10 trading days, I think you will have inevitably a short-term correction. But I think gold has a good 9, maybe 12 months of decent times ahead as interest rates are being cut. So we're not mega bullish. We're conservatively bullish at these levels because much of the rate cut cycle has already been priced in, partly because the long trade is looking a little bit crowded, partly because of the positive correlation with equities, and we don't love US equities in general at the moment. All these factors make us conservatively positive, but we are very much positive.
You throw in a couple of wars, you throw in a bunch of geopolitics on top of that. And I think I was shocked when Bank of America came out last year and said they saw $3,000 gold as a potential. We may hit that. I don't know if your view is that high or not, but yeah.
Not far, but not quite.
What's your thoughts, Scott?
Yeah, I mean, I was impressed with how strong it's been just based off the central bank buying, even ahead of the rate cuts here. So, if we see continuation of China adding, and I don't know if you saw this story about August imports into India, but those were a record high in August. So, I mean, the physical demand seems to be the strongest that I can remember in the last 10 years.
And I guess the other thing there is the gold price and the disconnect from equities, even the major producers, mid-tiers and developers and the juniors. I think that goes hand in hand with this discussion as well.
I think traditionally we've had a disconnect also because the cost of production for gold had been going up despite the spot prices going up. What is the expectation industry-wide in terms of the overall cost of production? Do you think that we continue to see still an edging up of cost?
So let me talk to that as with my Equinox hat on for a second as a producer. We're starting to see inflation, and a lot of those costs leveling off quite a bit compared to last year and the year before. Probably on average, you're seeing across the industry, the mid-tiers and the majors sort of cash cost around $1,500 to $1,700 an ounce, and then you start looking at an ASIC and you're up closer to 19. I don't know what you've seen, Scott. So there's still margin left at these kind of prices. So I think a lot of the companies are going to throw off a lot of free cash flow. your thoughts, Scott?
Yeah, I mean the recent run up here is well outpacing inflation. So yeah, I agree. I think a lot of the margin expansion you kind of got from 1700 to 2000 went away with the cost curve. I mean, you saw the tier one producers kind of up around a $1,500 ASIC there, and I think that's what had continued to disappoint the generalist investor. But with gas and oil prices going the other way here in the near term. And capital cost inflation rolling over. Hopefully, there is actually some cash that accrues to balance sheets over the next couple of quarters.
Yeah, look, I think on balance, our view is that costs will continue to inch up, maybe not as aggressively as they did, as you guys noted in the previous 2 years. Pardon?
What sort of inflation cost?
No, I wouldn't expect more 5% increases. The other thing to keep in mind is that costs tend to inch up naturally when prices are high because miners can spend more money. So you do get that cost discipline gets out of the disappears when you have the margins, the prices that you have now. And these guys here can tell us more about how they would see things, but what I would say is that notwithstanding the scope for the cost base to inch up, I think the price strength will trump it by a mile, and
Yeah, we're starting to see a lot more capital cost and operating cost discipline out of producers. If you think back to after 2011, there was a lot of deals that were done in the market, a lot of consolidation. I can think of one in particular. Kinross acquired Redback, and that was, Scott, what was that, 7.5 billion? There's a lot of more constraint in this time when we're seeing the gold price up, a lot more looking at internal cost reductions, brownfields exploration. We're just starting to see a cycle of M&A happening. Newmont's and several other majors have gone in and acquired assets recently. I think we're at the beginning of that. I mean, Scott, you're a banker, or ex-banker, reformed. What's your view on that?
Yeah, I mean, I think after the last cycle, people got punished. There's not many CEOs left from those days, for some good reasons probably. But they're just starting to, I think, feel the pressure of having to add reserves. What's a bit paradoxical is, I think some tier one producers are looking at evaluating assets at gold levels that are lower than their own ASIC. So some of that kind of has to true up, I think, and people have to adjust their expectations of where returns should be in the current cost and inflation environment. And people have to get comfort that the gold price isn't just going to pull a quick 180 before they're willing to pull the trigger on those type of deals. But hopefully that improves the valuation gap over time for companies like ourselves, and hopefully brings more supply online as well.
So you started to talk a little bit about the central bank purchasing and how that had a big impact on the gold markets overall. So do you see that continuing, and what other sort of macro factors do you see kind of impacting the space moving forward?
there's no doubt that the aggressive buying that we had in 2022 and 2023 has slowed, but central banks are still buying, and they're still buying comfortably above historical norms at volumes which are comfortably above historical norms. So in my mind, the central bank story is extremely positive for gold, and the fact that even at these historically very high prices, you're still seeing volumes going into reserves. I think that's very positive.
How much of that do you think is just trying to get away from the US dollar?
Oh, for sure. Look, de-dollarization, I don't particularly like that word, de-dollarization, because it implies that the dollar is dead, or we're moving away from the dollar as a reserve currency, which is clearly not what's happening here, right? What we're seeing, in my view, is a diversification away from the dollar, and this is something that's been going on for 20 years now, since the early 2000s. Post Ukraine Russia, I think what's focused the mind is the ability of the West, whatever that term really means, to basically weaponize currencies and lock reserve managers out of their nation's wealth, so to speak. I think that's focused the minds of many reserve managers, even within jurisdictions that are very friendly to the United States.
Yeah, I found this article today that's kind of interesting. It's talking about 2023 gold consumption versus domestic supply. And if you take India, for instance, they have 15 tons and they've got 748 gold consumption. So they produce 15 tons domestically. China, 378, and they've got 910 tons of gold consumption. Then you look at Russia, and this goes to the war. They basically have gold consumption of 71 tons, but domestic supply of 322. So they're selling a lot of their gold into it. And then you look at the U.S., 167 tons domestic supply and 249 consumption, and on and on. So that's kind of interesting. And I think it's accelerated in 2024, particularly in India, China, and the U.S. I don't know your thoughts if you track that, but it's kind of interesting to me.
Yeah, I think in my mind, the most interesting thing about this 2024 rally is that in previous cycles, every single precious metals analyst would tell you, oh, if gold goes up by 10, 20%, physical demand will disappear. It will all crap out. You won't be able to find enough refineries to process all the scrap that's coming back. And we really haven't seen that. Look, without a doubt, demand has taken a hit. Chinese jewelry demand is pretty poor for like 3, 4, 6 months almost now. But other areas of physical demand have remained resilient, and that's been that talks very much to your point.
Yeah.
India was, of course, it was helped by the cut in the local duty, but it doesn't matter. The fact remains that it's going gangbusters in a very, very high price environment.
Yeah, and then countries like Turkey were buying quite a bit as well, and on and on.
Maybe we can talk a little bit more about that physical demand. I spent the summer in Toronto, and people were talking about going to Costco and buying gold bricks. And
Yeah.
what do you take, from that?
So I have a house in Seattle, and grew up there for the last 20 years, or I lived there, I should say, and that's Costco's headquarters, right? They would get an allocation of 200,000 ounces, and it was gone in minutes. And it just, that retail interest is real strong. I know it's strong in Canada too. Maybe you can comment about that beyond Costco.
I mean, we're the same as the U.S., right? I mean, everyone's seen the inflation, and I think people believe that the value of their dollar is going to continue to get eroded. They're looking for really any way to protect it, whether it's physical gold, whether it's Bitcoin. Everyone's got a different belief system, but or real estate, but whatever they can do to stop their dollars from being eroded, I think people are doing.
Yeah, and look, Costco is particularly interesting because it opened up gold to an investor that previously had no idea how to go out and buy gold. So that's actually not a market share play. It was a genuine growth of the overall pie.
Maybe just a general question as well. What do you see in terms of sentiment among generalist investors in this cycle versus the last full cycle of gold? Has it been any different in your sense?
So in the producing companies, we're starting to see more generalist interest. It wasn't there sort of the last 18 months. You go back 18 months ago, it was barely there. It's starting to pick up quite a bit. I think part of that is on the equity side, believing that the free cash flow of a lot of the producers will continue. You look at somebody like Agnico Eagle, they've done extremely well. The Newmonts, the Barracks, the three majors, and then some of the better mid tiers. So I think that's a big part of it.
but the generalists have not, you know, trickled down to the junior developers, and they're just not present in the space at all. I mean, you go to these conferences, they're not there.
So in the last heated cycle, which was like, I don't know when was the last peak of gold?
2011.
Yeah. Were the juniors outperforming the core?
It was just a lot tighter valuation gap. I mean, if you look right now, you know, the top 10 gold producers in the world probably trade around like a 1.2 times PNAV, and junior developers right now are about a 0.3 on the low side. Junior producers would be about a 0.7. So I mean, there's almost a full turn of valuation multiple between the senior producers and developers. You know, it probably would have been probably like a 0.5 to 0.7 at the most, but probably 0.5.
Maybe we can talk a little bit more about that interest in the junior mining space. We've got two corporates sitting on the panel. You know, what are you going a little bit more into? You know, what you're hearing from the market and from your peers as well. So where is that interest?
Scott, maybe you can talk about some of the other companies other than Lumina Gold that you've been involved in that are more on the exploration side of the junior space.
Yeah, I mean, I'd say where we have seen the interest in the junior space, it's been in companies in safer jurisdictions. People are very risk averse. I think a lot of PMs have been suffering from redemptions over the last several years, and they've been suffering from very specific blowups in their portfolio. You know, like even recently, you think about Victoria Gold as a single asset producer in Canada. People would have thought of that as a, you know, a fairly safe cash flow play, and then all of a sudden there's an issue at the mine, and you know, 90% of the value's gone in the portfolio. So I think people have been risk averse. I think they've been whatever way they can mitigate that. So, but that's mainly been through geography. So there's a big premium for any later stage Canadian, US assets, but the interest has been really tough in South America and Africa. You know, at least in the Canadian market. You know, I can't speak to the ASX as much, but in the Canadian market, it's been really hard raising dollars.
Not really on the junior side.
Yeah. So if you look at the developers like Lumina Gold and quite a few of the other companies that are in the development space, fairly advanced at pre-feas or feasibility study level, you're tending to have to take these projects further and further down the de-risking path before you start to see much change on the equity valuations or in the mergers and acquisition. And you look at, so with Equinox, we just completed the Greenstone build. It was $1.25 billion initial capital build. We did it on time and on budget. But you had Magino and Argonaut. They took the thing all the way into production. They had some major overruns, but Alamos came in and acquired them. So what you're seeing sort of in the developer space is that sort of trend where before you get the re-rate or before you get taken out, you're having to go further down, de-risking the projects, get permits, maybe get into construction. One to watch coming up is Artemis and their Blackwater project that they're in the process of constructing now. Whether they're a potential takeout target or not, we'll see. Scott, you got any thoughts on the development space?
There's not a lot of projects left. I mean, most of the Canadian or US ones have been bought. So I think companies are going to have to start going, you know, wider afield, and you know, reintroduce that risk into the, you know, like you look at Agnico, they used to have a very clear north-south strategy, and I think they tried to be, you know, a bit equal weighted between that. But almost all of their M&A over the last 5 years has been in the north, right? So, you know, that stuff like that has to swing back at a certain point.
I was going to ask about M&A, and you know, there were kind of, it seems like it's fluctuated in terms of interest over the past few years, but are we seeing more M&A happening within this space, especially in the smaller end?
Yeah, I mean on the producer side, there's definitely continued consolidation. I mean, even in the last couple of weeks here, we've seen Gatos get bought in Mexico for about $1 billion. We've seen Sentiment get bought in Egypt, for a healthy valuation. But
Greenstone, don't forget that.
that's right. Equinox bought the other 40% of Greenstone for $1 billion. So I mean, any of this in the producing stuff continues to pick up. We haven't seen any junior explorers, resource level co's really of note get taken out for significant valuations. So to Marshall's point, you do have to take these things further along than you used to have to see that M&A. But I think boards are gonna struggle over the next couple quarters if prices stay up here, because you can only buy back so many shares and you can only do so many dividends in an industry with finite resources. And I think there'll be some pressure on CEOs and corp dev teams to, get active again and dust off a lot of these projects that, maybe they passed on at $1,800 gold, but in a $2,600 gold environment, you got to relook at everything, right?
Yeah, another case to look at is in Ecuador. We have Lumina Gold in the Cangrejos project, but we spun everything out, all our other assets, into Luminex Resources. And Luminex Resources and Adventus merged in January of this year. And basically, both of the companies were trading probably below a 0.1 PNAV, 0.1, 0.2 PNAV. Then the companies merged, and then Silvercorp came over the top and acquired the merged company. And basically, Adventus had been advancing the El Domo Curipamba project, got the permits basically in place at the time of the acquisition, and now a new mine is going to get built. So that's one example in the junior explorer developers that I can think of off the top of my head without the mid-tier and majors.
Yeah, that's a little bit more copper, and yeah, I mean the copper industry obviously suffers from a dearth of kind of buildable projects with low capex.
But
yeah.
it does have gold.
Is there any supply concern for the industry?
When you say a supply concern, you mean, are we running out of supply growth?
Yes.
No, I don't think so. And I think, in addition to whatever projects you guys managed to bring on board, you can't ignore the scope for artisanal and small scale mining to continue ramping up in this price environment. These are operations that are naturally high cost because they have small scale, and at these prices, we're definitely seeing significant growth from them. I forget the absolute figure, but I would say 15% of global production, 12 to 15% of global production, maybe 350, 400 tons. No, it's all over the place. Africa, LATAM, some in Southeast Asia, East Asia, Indonesia, Philippines, some in Myanmar, some in Laos. So that it's quite diversified, and each jurisdiction is quite small. But when you add them all up, and obviously each asset is very small in its scope of production, but when you add them all up, you're starting to add up to significant volumes.
Yeah, and I think what happens too, back to the producers, sort of the mid-tiers and the majors, they're starting to go lower and lower in their cutoff grades as the price goes up. We have in Equinox, we have a really low-grade mine that we're mining in California, Mesquite. It's sort of towards the tail end of its mine life, but they've been saying that for over 20 years, and it continues. And we're heap leaching 0.228 to 0.3 grams per ton gold and making money on it. So as the price goes up, you're going to see more and more lower grade production come in, and that goes to your point about lack of supply constraint.
So I thought we could touch on some of the other precious metals. So probably mostly bringing in Nikos into this discussion, but with gold being at all-time highs recently, how is that impacted the other precious metals?
Well, it's clearly supported silver. Silver's not performed as well as silver bulls would have wanted it to. I think that's largely because of how crap copper has been recently. The pressure that it's been under. It did extremely well when copper was rallying briefly, and then its relative valuation to gold again moved in the wrong way. Um, PGMs, I don't think are being supported that much by gold. They should have been, or received wisdom says that they would be, but they really haven't. And I think that's because investors are not keen on their fundamentals, really, their supply-demand conditions and their outlook.
Well, rather asking you where the price is heading, my question is, do you think that Trump will win?
I don't know.
I suppose the question is, how will the US election impact where gold will go?
So I guess I'm the only American here, so I don't have a good feel for it, really. I think probably part of it's already baked into the equation one way or the other. So there's one side of the coin that says, okay, you're going to get higher taxes, you're going to get more stimulus spending, more inflation. That's one side. And then you've got the draconian other side of that going the other way, tax cuts. And so I don't know what the outcome's going to be. Your probably guess is better than mine.
It's probably the same deficits either way, right? More
Yeah.
or less.
It's going to continue. It's going to grow.
Yeah, this is the thing. I don't think it makes any difference. It's if you compare the fiscal plans or the fiscal expectations of both candidates, I mean, they're both ridiculously imprudent. So that points to a debt burden that will continue to increase, and that's on balance positive for gold. It's as far as I'm concerned, it's more the quality of the spending and the receipts that will change rather than the absolute levels.
I would say at our last event in New York, the discussion around kind of the impact of the election, it mostly hinged more on kind of the energy transition thematic and those battery metals and how it would impact those rather than gold, which is more kind of influenced by market.
Yeah, but keep in mind that the US was never particularly fond of electrification, even during the times of when you would expect incentives, etc. Just consumers just didn't particularly like them for pretty good reasons. The type of driving that people do out there is not conducive to battery vehicles in the same way that it is in China.
I thought we could just kind of have, a look forward for the precious metals markets, for the gold market specifically. How the juniors will fare in the next couple of years. So, any kind of thoughts, predictions, or words of advice to investors?
I think one area that we see a lot of upward movement pretty quickly in share price is still discovery in the junior space in the gold discovery. Basically, if you get some really good intercepts, we see stocks run. I think as you get further and further and define resources and get further down the feasibility study sort of angle, you get into what has been called the Lassonde curve. So you get into low news flow, kind of moving along. You don't see a lot of movement there, but I think the drill bit is hard to predict who's going to hit what. But that's where I've seen the most gains here recently in the market. Scott, I don't know your views on that.
Yeah, I mean, I think if the generalists do own a gold stock, it's typically, they'll own the GDX or GDXJ or maybe a name like Agnico. But I think people are going to have to start to rotate down, and whether that's junior producers or developers or explorers, they're just going to have to, because the valuations are getting toppy on the senior names, and I think as more money flows into the space, it'll just have to rotate out, and you'll see more torque in the junior stuff here hopefully soon.
Can I just jump in to ask, what should investors be looking for if they are looking to get more into those early stage projects?
Yeah, for sure. I mean, so on the junior producer side, I mean, you could make an argument you're going to get higher returns on some of the ironically the poorer names where costs are high, and those companies haven't been doing as well. But the guys who are on the kind of Q3 end of the cost curve, but they should see the most benefit in this environment. Developers, I think you got to ask yourself what's the path to liquidity, whether it's your thesis is that's going to get sold, or you think they'll get that construction financing and get the re-rate, or the permits and get the re-rate. Explore codes, that's a much more difficult game unless you're a geologist.
Yeah, and I think there's a point there, like a track record of management teams, exploration teams that have done this over and over again, I think is a key to the junior explorers. And there's a couple handfuls of groups that are serially successful. Our group is one that's done pretty well, but we've tended to be more development, advanced exploration oriented. But there's a lot of groups that are project generators and have done it over and over again. So those are some of the groups to take a look at.
Nikos, any closing
We
thoughts?
don't really offer a view on
Mhm.
equity investments. We're very much a commodity focused group, not least because most miners are our clients, so we don't want to piss any of them off.
There you go. We got to laugh. Good
Is there an
job.
outlook on the price?
Pardon?
On gold price, like 12 months, 18 months?
Yeah, look, as I said, we're conservatively bullish at these levels. I think in the very near term, we are looking for a correction, whether it's a 5, 7, 10 potentially % correction. I think that is a good entry point, with a caveat that this is not investment advice, obviously, always. And I think we will see new all-time highs into 2025. I think once you go past Q2, Q3 2025, we're less excited about gold, because once the interest rate cutting cycle is over, I think there'll be a period of pause. And fast forward another year out, central banks have been buying gold aggressively. There will come a point where they'll reach the magic percentage level that they want, and maybe they won't be that keen on, or they'll be buying, but buying less. So I think from late 2025, 2026, there we're a bit less excited about it.
Any thoughts on what that all-time high is going to be?
I mean, it really is just get a blindfolded monkey and have them throw darts at a wall. To be honest, but could be 27, could be 28. Our view is that it's not that it will get to 3,000, but look, if you came to me and you argued, no, I really think it's going to go to 3,000, I wouldn't really have anything serious to counter argue against it. We are in uncharted territory, so in theory, the sky's the limit.
Yeah, last year I predicted $2,000 gold and I was wrong. Look at where we're at now.
Have you guys done any work on kind of the volatility, or kind of where the new floor is, if there is the downside to it?
We've tried to do that in the past, and it was so spectacularly wrong that we gave up on black box approaches. What I would definitely say is that the floor has been grinding up very much because of central bank buying over the last 2 years, and earlier this year also because of Chinese demand and consumer demand in China that was very supportive.
Yeah, the other thing we haven't really touched on is long-term consensus price predictions on gold. I mean, we've seen it move over a couple $1,000s an ounce here, and that's the first time I've seen those sort of levels. Scott, I don't know, you look at this quite a bit.
Yeah, it's been shifting up all year. So I think right now we're just a shade over 2,000. But, you know, those are the numbers that the analysts have baked into their cash flow estimates. So, I mean, obviously, every quarter we're $600 an ounce over where people are running long-term models. It's going to continue to surprise to the upside, I think, and grind equities higher.
Grind is the key word, right?
mean,
Slow.
Another anecdote that might be of interest. I was in New York for Precious Metals Week. I did not meet one, this is a week where everyone from the precious metals industry goes to New York. There's series of events. Everyone gets really drunk and hung over the following day, and they try to have meetings for the whole day. I did not meet one person who was bearish or one person counterparty client whose customers were outright bearish. I mean, don't get me wrong, there's some tactical shorting when the price rallies, etc. But nobody in the market seemed to have solid bearish view, and that either tells you that the price is going up by another $500 or that we're all wrong and it's gonna crap out in the next 6 months, and we won't get invited next year to speak.
But I mean, that's on the physical side. If you listen to equity research analysts, you know, like I was listening to the RBC analysts the other day, you know, no enthusiasm around the record highs, and, you know, listening to the head of a sales desk the other day, similar, no enthusiasm. You know, I think he used the phrase, "Oh, metal prices are pretty good." Well, no, metal prices are at a record high, and there's just no enthusiasm on the equity side for that. So there's you know, definitely that disconnect between the physical market and the gold equities.
I want to thank our panelists for joining us here today.
Thank you.
Thank you.